Why Silicon Valley Bank collapsed. Silicon Valley Bank, also known as SVB Financial Group, was founded in 1983 to provide banking services to startups, venture capitalists, and technology companies. It was one of the few banks that understood the unique needs of the tech industry and was able to provide customized financial solutions to its clients. However, the bank's success was not always constant. This video will take you through the rise and fall of Silicon Valley Bank, along with the timeline of events and share price fall. In the early 2000s, Silicon Valley was in the midst of a tech boom, and Silicon Valley Bank was right at the center of it. The bank had built a reputation as the go-to financial institution for startups and venture capitalists. Its focus on technology and innovation set it apart from traditional banks, and it was able to attract a loyal customer base that appreciated its customized services. SVB Financial Group went public in 1997 and continued to grow steadily throughout the 2000s. The bank's profit soared, and its share price rose to record highs. In 2004, Silicon Valley Bank's shares were trading at around $80, and it had a market cap of over $3 billion. The Great Recession, which began in 2008, had a significant impact on Silicon Valley Bank. As the financial crisis hit, many of the bank's customers were unable to pay their debts, and the bank's loan portfolio began to suffer. The bank's profits plummeted, and its share price fell sharply. In 2009, Silicon Valley Bank reported its first-ever quarterly loss, and its shares were trading at around $12, a significant drop from its peak. The bank was forced to cut costs, lay off employees, and restructure its business model to survive. Despite the setbacks of the Great Recession, Silicon Valley Bank was able to recover and continue to grow. The bank focused on strengthening its balance sheet and diversifying its loan portfolio to reduce its reliance on the tech industry. It also expanded its operations internationally, opening offices in China, the UK, and Israel. In 2015, Silicon Valley Bank's shares were trading at around $150, a massive recovery from its low point during the recession. The bank's profits were growing, and it was once again the go-to financial institution for startups and venture capitalists. Unfortunately, Silicon Valley Bank's success was not guaranteed to last. In 2018, the bank's shares began to fall again due to concerns about its exposure to the tech industry, which was facing increasing regulatory scrutiny and investor skepticism. The bank's loan portfolio also faced challenges, with many of its customers struggling to raise funds. In 2020, the COVID-19 pandemic further exacerbated Silicon Valley Bank's challenges. Many of its clients were forced to lay off employees or shut down. In 2022, SVB began to incur steep losses following increased interest rates and a major downturn in growth in the tech industry, where the bank's liabilities were heavily concentrated. As of December 31, 2022, SVB had mark-to-market accounting unrealized losses in excess of $15 billion for securities held to maturity. In early March of 2023, a combination of factors, including poor risk management and a bank run driven by tech industry investors, caused the bank to collapse. Examiners from the Federal Reserve and the FDIC arrived at the offices of SVB early in the morning of March 10 to assess the company's finances. Several hours later, the California Department of Financial Protection and Innovation issued an order taking possession of SVB, citing inadequate liquidity and insolvency, and appointed the FDIC as receiver. The FDIC then established a Deposit Insurance National Bank, the Deposit Insurance National Bank of Santa Clara, to reopen the bank's branches the following Monday and enable access to insured deposits. According to Reuters, after the SVB was closed by regulators, the CEO of Silicon Valley Bank, Greg Becker, who was previously on the board of directors at the Federal Reserve Bank of San Francisco, exited that position. The failure of SVB was the largest of any bank since the 2007 and 2008 financial crisis by assets, and the second largest in U.S. history behind that of Washington Mutual. SVB's Chinese joint venture, whose chairman is the chairman of Shanghai Pudong Development Bank, said their operations were sound as of March 11, 2023. The UK government announced that they were working on a lifeline for British tech firms affected by the collapse of the bank and their branch in the United Kingdom as a part of the fallout from the parent bank. On March 13, 2023, HSBC has agreed to acquire Silicon Valley Bank UK for £1 in a rescue deal. The bottom line of why they collapsed was because they had poor risk management. Instead of just buying short-dated T-bills or depositing with the Federal Reserve, they bought long-duration fixed-income securities. This caused an asset-liability mismatch, lead to liquidity issues, lead to bank run, lead to collapse. They then failed to manage their interest rate risk by simply not hedging their exposure at all. They had $120 billion worth of securities. When interest rates went up, they took a massive $1.8 billion loss on their available-for-sale bond portfolio. They had $80 billion in bonds with an average yield of 1.5%. This is criminal risk management, but this is also a massive regulatory failure. It's highly unlikely this spreads to the biggest banks. SVB collapsed because they had the highest risk deposit base among U.S. banking peers. The big banks are in way better shape than 2008 due to regulation and capital buffers. They actually stand to benefit from this by taking market share. Nearly half of all U.S. venture capital-backed startups did indeed hold banking relationships with SVB. Gary Tan, the CEO of Y Combinator, called the fallout an extinction-level event for startups. These depositors will not survive weeks or months without some sort of plan from the government. Over 95% of SVB's deposits are not insured by the FDIC due to being over the $250,000 limit. That is over $160 billion in uninsured customer deposits. This is awful for early-stage companies that were simply just looking for somewhere to hold their cash for operations. Just days before the collapse, executives sold millions of dollars of stock. Gregory Becker, CEO, sold 11%. Michael Zucker, General Counsel, 19%, Daniel Beck, CFO, 32%, Michelle Draper, CMO, 25%. Unbelievably, their chief administrative officer was the CFO of Lehman Brothers when it collapsed. They also went months without a chief risk officer. Yes, really. Silicon Valley Bank was hailed as one of America's best banks by Forbes magazine just about a month ago. They ranked 20th out of 100. It's now quite likely that a big bank buys them up next week. Elon Musk even said he's open to the idea of buying them. SVB CEO was on the San Francisco Federal Reserve's board. He's not anymore for pretty obvious reasons. The massive debate now is around whether they should get bailed out by the Fed or not. This has massive implications for the depositors, which are companies and major VCs in Silicon Valley.